Good morning, everybody. Welcome to the Industrial Insights podcast. We have Jesse Gundersheim of CoStar with us today. And Jesse is my favorite CoStar rep. So I love it. You write all of the articles, maybe not all of, but many of the articles. And I love collaborating with you when we have presentations and we're looking for insight and working together to know the data and know the story and compare it with our experience out there in the marketplace. So I'm excited to go over kind of the Q2 stats now that we're past halfway in the year for Southern California industrial. And we'll be going through a couple slides that won't be present on a podcast, of course, this being audio, but that can be available by reaching out to Jesse. And I figured we would hit the summary real quick, Jesse, after perhaps you give us a little background of how long have you been with CoStar and what are some of your favorite parts of working there?
Yeah, sure. Thanks for having me on, Justin. CoStar is a fun company to work at. We're on a mission to digitize the world's commercial real estate. And I have the fun pleasure of working with my research team to monitor all this data, see what's happening in the markets here in SoCal, County, Inland Empire, and a bit of LA for industrial. And I've been with the company about 7 years now in this role of market analyst. So yeah, primarily write the market reports and sub-market reports that you find in the product. And I make presentations to our clients to share what I'm finding in the market and hear their experiences.
And recently Inland Empire and Orange County and now LA County. So that'll be a fantastic experience and journey for you, I would imagine. It's a big place. I thought the Inland Empire was huge. LA County is, yeah, that's pretty sizable too.
Yes, the two largest industrial markets that we have by asset value, and Orange County actually is a sizable market as well.
Yeah. So the summary for when we just think of Southern California industrial, what are some of the high points?
The high points, yeah. I think of it, it could be characterized as maybe the good, the bad, and the ugly, depending on how you look at it. So we could start out with the good, and that's the leasing activity. It looks like there could be a rebound afoot, right, in terms of tenant demand. So we did actually see a record volume leasing in the Inland Empire in the second quarter in history. So that was pretty good. LA jumped up a little bit, looking like they were at a high last seen in 2021. So it's been a couple years since we've been at the level of leasing in LA. So that's probably the good. The bad is that vacancy does continue to rise. Right? There's occupancy loss in LA, and LA is really the worst industrial market in terms of fundamentals across the country. We've seen occupancy decline pretty severely below even pre-pandemic levels. And it continues to lead the country in decline in terms of
that's the benchmark we use. Yeah, pandemic, pre-pandemic. Where are we at?
Yeah, a lot of markets like the Inland Empire, saw that flurry of activity in 2021, 2022, as tenants expanded to that rush in e-commerce buying. But LA has actually had a slight rise and has gone downhill since then. So
yeah, it's interesting. Sometimes I think of their rent increases were some of the highest during that period of time, and I'm sure that's partially attributed to it, just like the limit of how much cost can be transferred onto the tenant and their ability to still grow and thrive.
Yeah, that's true. One of the most dynamic markets and one of the most volatile in terms of rent over the past decade. And it's led to a unique situation. Rents are falling right now, but they're still up from, say, 5 years ago or 10 years ago. They're up substantially. It's one of my charts. I think LA rents are still up 33% from 5 years ago. And
your cumulative rent growth slides, I love them. It's such an interesting way to look at it, because if you look at 5 and 10 years, the stats were 50 and like 150% rent increase. So even though the last 2 quarters have gone down, it just makes you cognizant of how much they've come up in a short period of time.
Right. There's still that potential to mark rates up to market rents. And so that's what I think has investors still interested in the market, even though rents are declining and they're leading the nation down. We have them down even 16% in LA. But as I mentioned, the 5 year, the increase was just so strong in 2020, 2021 that the 5 year ago rate was like 33% lower as we have it.
Yeah. 2 years and 3 years from now, we'll see what those numbers are. It'll be an interesting way to see changes. And the deliveries, we all think that approvals and entitlements are increasingly challenged. There's another new legislation that's across the board that's trying to get passed that would further limit it and like a restrict development. And it seems like going through some of the net absorption and delivery and vacancy graphs that are those fantastic graphs that tell the whole story in one picture, that we still have some deliveries coming. It's not like we've hit that delivery cliff that people think about.
Yeah, absolutely. It's down. But one thing when I combined the graph for SoCal, all three markets, I was kind of a little bit surprised to see we're back down to 2017 to 2019 construction levels. So we've dropped from 55 million square feet underway to 35 million square feet across SoCal, which is a substantial decline. But again, it's still a fair amount to get through. And again, about the same levels of active construction that we saw pre-pandemic. Still growing. Actually, our airport area submarket in the Inland Empire was the fastest growing submarket in the entire country over the past year. It's already the largest. And we've got, yeah, still growth out there in the IE and some new buildings even in LA and in Orange County as well.
There are still a couple massive projects near the airport that are like just at their inception. That will be several million feet. Yeah, that's a hot place to be.
It is, yes. And certainly there's pushback from community that's growing, I think. And it's going to be harder to build in the future, no doubt. But there is a lot of already entitled, already approved projects that are yet to initiate construction. So I think, if there's bandwidth for it, if the demand comes back as expected, there's still a fair amount of supply that could be built over, say, the next 5-year period at least.
Yeah. And I was thinking another fantastic one you had was leasing absorption by vintage, right? And so it was the moral of the story was new buildings are leasing better than older buildings, right? But it was then in 3 tranches. So you could kind of see like early 2000s construction. And so that's where the rent growth is the highest, right? That's where deliveries will be hitting. That's where like absorption is the highest. And so that would tell you that's where it's at, or that's where the bulk of the action is.
Yeah, absolutely. Those new buildings are filling up, maybe not as quickly as they were a couple years ago. But yeah, we're seeing the occupancy loss in the older stock, whereas those older buildings were being backfilled kind of in the first couple years after the pandemic. Yeah, we're seeing the occupancy loss in the older stock for sure, and new buildings with higher clear height, maybe higher power capacity, taking the bulk of demand.
Yeah, and I wonder where the buildings end up in Orange County and LA that are Rexford buildings, where they are older buildings, but then they make them new again and put a lot of the modern features back in, and then they capture some of that increase, right? That's their business model, which is awesome. So you could see that graph right there is taking advantage of that, or like as much as there is in that value add proposition.
Yeah, and in infill markets like OC and LA, I think they're cognizant of the fact that supply growth really isn't overwhelming and that demand could snap back. And if it does, the absorption is going to bite through the whatever is vacant pretty quickly, right? It's not going to take several years to eat through this recently vacated space if demand turns back to historical levels. And so they're continuing to build. We had over 8 million square feet actually started for construction across SoCal in the second quarter or so. The pipeline is declining, but nevertheless, there still starts happening.
Yeah, tell me about building sizes and how one size does compared to another. I feel like
Yeah.
that's a great way to divide the market, not just between geography, but also size range tells like the other like third of the story, maybe.
Yeah, and across all three markets, it's been a similar story where the smaller size, the small bay buildings have remained in stronger demand. They are still seeing a lift in availability and vacancy, but it's really
We're
the mid.
calling small bay 50 and under.
Yeah, 50 under the tightest, but then next to that 50 and 100. And it's the kind of the mid-size to builder to larger buildings that have struggled the most. 100 to 250K, that's kind of in a sweet spot for both occupancy loss, but also development in kind of OC and in broader LA and Inland Empire as well. There was an interesting note though in the Inland Empire, the 100 to 250,000 square foot size range We've got availability ticked all the way up to 16%, and then it's down about 100 basis points in the latest quarter. So I think it was you that was sharing, a lot of those buildings are used for pure logistics plays. And I think we've seen maybe the stemming of the tide and occupancy loss in that, and a bit of a jump in leasing demand for that size of building more recently.
If we got a positive net absorption again, and that's where it's being affected, right? That would tell you that in the numbers and anecdotally, amount of requirements like we see and we have that are in that size range are increasing without a doubt. I found right now for us, just as a team, it's in like the 250 to 300 range, maybe even like 2 to 3. I feel like we're seeing more people that are in the 100 to 150, that the ones that have the growth potential in this market are making those moves. I don't know if that's specific to our team or in the market, but just like that's what we're seeing out there. So we'll need to backfill those 100 to 150s.
Yeah, those
Yeah.
mid-sized ones. And then the big ones, the mega warehouses, say there's only 2 under construction or existing warehouses of over 1 million square feet that are available for lease right now in Southern California. So that actually maybe ticked up to 3 or 4, but it's definitely less than a handful. And occupancy is stronger in that million plus segment, even in the 500 to 1 million size range.
Yeah, I have seen sometimes it'd be up as high as like 15 or 18, which blew my mind. But then when you dig into it, so many of them are planned. They're still working on entitlements. If you go out there, you see Field of Dreams. Like those don't count because you can't lease those right here, right now.
Exactly. Yeah. There's options to build. We're trying to track when actually foundation is poured. And we'll get told sometimes, yeah, we started development on this project, and we'll follow up with some field researcher and looks at satellites and actually really try to find out when is construction actually underway with concrete.
Yeah, I love the stats when you think of how many buildings are available in a certain size range. Like that's such an easy rule of thumb or like bellwether of where are we at. So thinking of this, i.e., 100 to 150 size range that we're finding more tenants moving from, there being 64 buildings available. And it's funny. At first, that number is eye-popping, and you think it's alarming a little bit. But then when you really break it down to a specific need at a specific point in time in a preferred area with whatever the unique feature is that is most desirable to the requirement in hand, it always comes back to like 5 or 6 or 7. So like I get a little squeamish when I hear like 64, or
Okay.
even it was up to like 100 at one point in time about 6 months ago. So but it's a good way
Yeah.
to just like take the temperature.
Yeah, absolutely. And just looking at the map of where they are, it is spread geographically, right? This is a vast kind of land-sized market. And it's down to your point. It's I had 75 last quarter, so down certainly down, like you're saying.
Tell me about Amazon, Jesse. We all want to know what they're back. Then they stopped. Then we all worried that the party was over because they had stopped. And then they're all grateful that they're back again. And it's
Yeah,
in all of their sublease space. And is it going to crash the market because they're going to dump all the space and they're consolidating buildings into their like a mega spaceship, 3 million square foot plus buildings. So it's always great to see what is the biggest player in the market doing. How would you describe what they're doing at present?
yeah, ramping back up, right? Was a lull there in 22 and 23, but they're back expanding. They just opened the largest industrial building in the entire country in Ontario, over 4 million square feet, multi-level building, but still taking space. So they signed those 3 separate leases for 1 million square foot buildings in the Inland Empire in the first and second quarters of this year. Um,
Each
had it,
one a million or greater. Yeah.
mhm, taken down, some of those options. So it looks good. I'm not sure of their latest revenues, but they're certainly on expansion for real estate, not just in SoCal, they're expanding nationally. And I believe giving up less space for sublease as well. I know they had maybe 1 or 2 buildings out here in SoCal for sublet around 100 to 200K, but yeah, certainly expanding here and nationally. And that's probably due to the rise in e-commerce shopping. We see that growth trajectory really picking up over the past 3 to 6 months.
Are you still shopping, Jesse, in your household?
I'm still shopping. I moved into my house a year ago, so I'm still shopping on Wayfair and Overstock and looking at furniture stores, which has been
Yes.
kind of the down part of the negativity in terms of demand, right? There's been less demand stemming from, I know, and related to home sales, as there's less people moving into new homes. You don't need the furniture to stock them up. But on the flip side, it's kind of been e-commerce and consumer staples, which have been a boost to demand more recently.
If you are in the Inland Empire market, you see the furniture guys, the tenants that are out there that are in that business. And there's so many of them, and they're always up to something. So it is interesting to see a lot of them right now that are at the end of their lease. And then they're coming up with some version of, can I take half the amount of space? And then when it's time to grow that back, grow it in another lower cost market so that you can maintain the footprint here and still grow, but grow in another place with another cost profile. I feel like that's a story that's very prevalent right now, for sure.
Yeah. Yeah.
And so furniture isn't made here. It's usually comes through the ports. And we had a great analysis that had to do with net absorption in Southern California industrial and correlating with the port imports. So how are we doing at the ports these days, and
Yeah.
how correlated is it?
The ports are looking great. I actually had an opportunity to tour the port of LA, which I highly recommend. Just so fun to get right up next to those boats, learn a little bit more, learn about the empties that are going back. But traffic at the ports is looking good just in this latest month of data for the combined twin ports of Long Beach and LA. Basically back up to those peak levels. It looks like there's maybe 3 months that were higher during 2021 to 2022. But a nice uptick recently. And so, yeah, I've got a series of analysis that kind of smooths that out over the past 12 months to come up with a trailing year import, and then looking at the percentage change in that trailing year imports to SoCal, which is up around 18%, heading towards 20%. We've never really seen an upswing in that rate without seeing a subsequent upswing in absorption in SoCal, which really hasn't come to foot yet. So based on this historical correlation that I had, about 71% in the LA market and a little bit less in Inland Empire and Orange County. But based on those, stronger e-commerce spending and retailers have actually pared down their inventory levels. So they're bringing in more goods to the country now. You would think they're going to need more space to distribute those goods across the country. So it makes sense for absorption to tick up in the upcoming quarters.
Yeah, we're always thinking of like what is a leading indicator versus a lagging indicator, right? And we're always looking for the leading indicator, which is usually spending, right? Because you need to spend the dollar to have the good made, to have the good shipped, to have the good received, to have a place to put the good in the first place. But this is that true? And how long does it lag? And looking at your correlation graph, it's they are neck and neck in a lot of different eras in history, only up until now.
Yeah, right. It's only dislocated from at least 2005. Should go back further, but the past couple years or so is only the dislocation there.
Tell me about sales.
Yeah, sales and correlation.
That's the other that's the other side, right?
It's
Leasing is one thing. Yeah.
It's sales and inventory levels that are most correlated to absorption. And I think the port imports are kind of a result of that. But yeah, the sales look great. You can't keep down the U.S. consumer right now, apparently. I mean, there's of course increasing fears of a recession recently, volatility in the stock market, sure, but we still have income growth still outpacing inflation. So pocketbooks are padded and U.S. consumers are out there spending, certainly on e-commerce more than ever, and at a strong growth trajectory.
I've been fearing a recession for 20 years in a row now, Jesse. So let's keep it going. Yeah.
Right. The longer it doesn't come to foot, the more frequently I think, well, isn't this, the soft landing that we're trying to achieve?
Yes.
So we'll see.
Have we already done it? Are we doing it? Or has it yet to arrive? Sure is hard to know.
We're looking at potentially lower interest rates, it appears, from here on out. So, I mean, from that perspective, it should probably be a boost for businesses at least.
And so, if we're not talking about e-commerce sales, but building sales in the capital markets, building selling, it sure seems like it's slower and this confidence evaporated. And then is it back? And does that translate to velocity and like a closed deals? And it sure seems like it's slow to rebound. They're like, there's like, what is the play and who are the players that are affected from their buys from the last cycle?
Yeah, yeah. I don't know if we've seen volume necessarily increase yet. I've heard from investors out there that bids are getting more competitive, that there's more bidders out there for available investment opportunities. There's probably still fewer opportunities for purchase coming into the market. Yeah, but there are still transactions, of course. We see cap rates commonly in the 5% range right now, but as I mentioned earlier, still that often that potential to raise rents up to market rate on existing tenants. And so higher cap rates have led to, some capitulation and valuations are down a little bit from the peak a couple years ago. But, there's still active players out there, and there's still opportunities to invest and make strong returns on certainly longer term holds. If you look at the historic growth and the barriers to entry in the inner SoCal, then it's a strong investment thesis still.
Price per pound is how you get confidence when confidence can't be found, and just sizing things up of how comfortable do you feel on a price per square foot basis. And so that's always fun to think about dollars per square foot. And if the exit cap and value and lease rate is hard to pin down, right? That's like your gut check Wild West investor metric to just think like, okay, it's $300 a foot. How do I feel after having seen it be $400 and $500 a foot? Beyond, have we hit bottom? And right, it's those are hard ones to peg.
Yeah, they are. There are. It's always a higher risk, higher reward often. Um, and then just in terms of volume and maybe pricing, we think that there's probably at the floor is coming soon. With the posturing in interest rates, you typically have volume. I think it was 10 quarters in the great financial crisis, 10 quarters of sales volume decline across all property types. We've already reached about 12 quarters this time. So maybe reaching an inflection point in activity. The pricing typically floats around the bottom for maybe a year or so and increases after volume.
Yeah, slightly slower cycle. No cycle is the same, but it should have similarities. I know we're all ready. Yeah, it's interesting to think how cap rates vary across the counties. So you had a couple good pieces of data I thought that people would really enjoy of how cap rates are amongst the counties and then in comparison to the region and the country.
Yeah, well, across Southern California combined, I had a low cap rate median a couple years ago, 3.7, now up to the mid 5% range. We have as a market, Inland Empire, the lowest cap rate across the country, and then LA shortly after, and Orange County after that. So our three markets, I'm really hearing in the 5% range. That's what we're hearing commonly and seeing commonly. Virtually the only market, as I'm looking at the chart here, that's in that 5% range. Others are in the 6% range as a market average. So I think that just goes to show that there's still the demand here, right? Overall, and in comparison to other markets.
Yeah, without a doubt. I was seeing this 4.6 cap for Inland Empire, 5.2 for LA, and 5.3 for Orange County. And that's all assuming Class A properties, or that's across Class A and Class B?
Yeah, that's probably across all segments and has some volatility just depending on what happens to trade that quarter. The looking at just kind of 10 million sales of that are transaction value of 10 million and above is what I was kind of harping on in the 5% range overall. And for those deals over 10 million, we have pricing down about 14% in Orange County to 340 and around 6% in LA to 330 a foot.
Yes, that's over the last 2 years, I think.
Correct.
Which
and
would
even
be peak.
yeah, and the pricing, it does actually look to tick up this year, year to date, as compared to 2023 a little bit in both of those inner markets.
Okay. That if that's not a green shoot or sign of bottom, right? That's one sign anyways.
Yeah, at least stabilizing.
So if we were to sum up what we've talked about, Jesse, we have increased leasing levels, but not in the same places, right? And so we have a positive absorption in the Inland Empire. We're still sadly negative in LA to a good amount and in Orange County. And then availability increasing in all areas.
Well, not in inland. That leasing in Inland Empire has been strong enough to basically balance the new listings coming to the market. So the availability rate there has been steady since the first quarter of this year, right at 11.5%.
Got it. That's a good clarification. And then construction still going, projects still delivering, even if it's to a lesser degree. It seemed like those pipeline figures were still pretty healthy.
Yes, still some supply to get through, and there should be some completions over the next year. Still some starts, but starts are down from last year and of course the years prior to that. So a slowing pipeline, but still maybe half fill or moderately full.
Yeah. And I love the bottom line you get from Prologis sometimes, which is if that is the case and entitlements are increasingly difficult, and then you come back to e-commerce and consumer spending and port levels, you could see why they are betting on rent increases for next year or for the year thereafter and after that. And why the barrier to entry and the increased demand is still very bullish on industrial in general.
Yeah, I think so. I think institutional investors rushed into the property type maybe pre-pandemic a little bit, right? And those reasons that they did so are still there. Just a strong demand, strong historical rent growth, and I think it's returning to those levels.
Yeah. Well, Jesse, what I love is you bring the data part, right? It's interesting to see the anecdotes and the experiences, but until you've really gone through and done what you've done, where you spend a lot of time digging through, and that's a lot of data to digitize, right? And a lot of data to gather, much less to make sense of it and make meaning from it so that you can take meaningful action from it. So I really appreciate you and that you do that, and CoStar and what they do to help make the market have more transparency and clarity. And I don't know if you have any takeaways or where people can find you.
Yeah, you can find me online, Jesse Gundersheim. You can search for my email. Maybe we'll post it at the bottom of this. But yeah, it's always a pleasure, for me to monitor the markets and share what I'm hearing and to learn about what you're seeing in the market as a participant, as a broker, and to have those stories that you're going through with your assignments kind of resonate, validate what I'm seeing in the market trends.
Yeah, and for those who don't know, Jesse puts on webinars on occasion, so that might be another way we're connecting with you. You can get on the list for a webinar presentations for market updates in the future.
Absolutely, yeah. We're happy to host people and introduce people to our product. Anyone can go to CoStar.com, CoStar.com, and find out more information about the product.
Yeah, Jesse Gundersheim, CoStar. Thank you for joining. Have a good one.
Thanks for having me.